Yeah. Nice to meet you.
It's going to be a fun day.
Yeah.
Let's go ahead and get started. Just want to thank everyone so much for joining us. We have an awesome agenda lined up for you today. We have Naayem, the CBO and co-founder here at Dapper Labs for you all. And just so you know what to expect, we are going to start with a presentation from Mick, and then we'll move to the community pre-submitted questions. And right after that, we'll open it up for some live questions from the community. If you want to ask a question, throw it in the chat on Zoom, and we will monitor that chat. We'll curate the questions. I'll read your name and your question, and then we will go ahead and grill Mick for all of the knowledge that he has in his brain. Now, I know that I can't wait to learn more about fundraising and what it all entails, so I'm going to get out of the way, hand it over to the man himself. Mick, thank you so much for being here, my friend.
It's really good to be here. Thank you all for making it. And it's fun to be able to share about something that I spent so much time doing over the past 5 years. And something that's essentially can be quite a stressful experience because you tend to want to be fundraising at the time where you need to be fundraising. And so hopefully through this, I can kind of give you a couple of kind of tips and tricks, share some of my experience. And as Shaheen said, please feel free to pepper me with questions. I think the best way for me to add values is to answer your questions rather than through a bunch of slides. But let me get first started with the slides and get that out of the way. Can you all see the slides?
We can see it perfect.
So first, I thought I'd introduce myself. So as Sean said, I'm Chief Business Officer at Dapper Labs. What that really means is I spend most of my time interacting with the outside world and promoting the great stuff that we do at Dapper Labs. And so I work with Mickey and the team on partnerships for Flow and folks who are building on top of Flow, trying to help grow that ecosystem. I work with Katie on IP partnerships. And so we spend a lot of time trying to bring IPs like NBA to the blockchain and we build with those to try to kind of deliver great experiences that can touch millions of users and inspire others to build even cooler stuff than we do. And then I now spend a bunch of time on Baller Ventures, where we go out and evaluate and fund companies that are building on the Flow ecosystem that we get really excited about. Prior to joining Dapper Labs and Axiom Zen, I was founder and CEO of a company called Fuel Powered. We built a live ops platform for mobile game developers, and I grew that to over 200 million users. And it was acquired by a company called Animoca Brands, who now is also a big player in the crypto NFT space. They're the folks who created F1 Delta Time, for example. But enough with that. So I think the first thing to ask yourself kind of before you start fundraising is whether you should fundraise. And I think that as an entrepreneur, we always look at kind of other entrepreneurs and see them raise large numbers. We see very high valuations, and we think to ourselves, "Hey, I want to be like that." Those are the types of folks we want to emulate. But in reality, fundraising often is not the right path for a business. And when I say that, I mean specifically venture-backed fundraising. It puts you really on a path of having to grow and grow quickly, very, very quickly, and continuously. It's we call it the hamster wheel. It never stops. And so unless you're really trying to build a company that is going to grow very, very quickly and take a lot of risk, because that's what it takes to be able to grow very quickly. Generally speaking, fundraising from venture-backed companies is not the right way to go, because they will be injecting you with capital and expecting 5, 10, 20x return really, really quickly. So they'll be promoting you to move quicker than you may or may not be comfortable with. They'll be pushing you to take potentially much more risk, because the way they see it is they're going to be betting on 20 to 100 of these, and they just want one to kind of be a 1000x. And so the question should ask yourself is, am I building a business that am I building a business that I want to kind of grow at a comfortable pace that is going to pay my team salaries, my salary, and then over time build wealth through that? Or am I really trying to kind of build a company that will grow, kind of grow a market and or come into a market and take over market share in a very rapid way? And I would argue that most businesses are more of the former, the lifestyle business, than the latter. And I have seen time and time again, companies and entrepreneurs go into the latter rather than the former, even though they were more of a lifestyle business, and that lead to really bad outcomes. And so I think the first thing to do before you set yourself on this venture back fundraising path is to really look at your company in the mirror, look at your own ambitions, and what are the things that you want for yourself, and decide whether you want VCs to come into your business and drive you into a certain direction. So if you've decided that you want to go on this path, the next question is, when should you fundraise? And I think, generally speaking, it's best to fundraise when you have a clear idea of what you want to do, how much capital it's going to take to get you to the next step, what are all the steps between where you are and where that next step is going to be, and what is the return that you expect to get from taking in that capital. And by that I mean, where do you expect your business to be after you've taken that capital injection and either use that or gotten yourself to profitability. And that's really important, because that is essentially what investors are going to be looking for. I'm giving you this money, what am I going to be getting? But more importantly, it's really good for you to get a sense of how this capital is going to help you, because you're selling something that's really, really valuable. Your equity is something that is both finite and it represents all your blood, sweat, and tears. And so before you sell a piece of that, you should really have a clear idea of what you expect to get out of it, of how it's going to accelerate your company. The next part is the best time to fundraise is when you don't need money. And that's really, really hard to say, because as entrepreneurs, we always need money. But the reality is that when fundraising, we're dealing a lot with dynamics of power, and generally the VC, the person who's going to be giving you money, has all the power because they have the money, and so they're in a position where they can ask for a lot unless you try to switch that narrative. And one of the easiest ways to switch the narrative is to be in a position where you can say, actually, thanks, but no thanks. I'm okay. I will walk away. And so the best time to raise money is when you're generally in a position where you can live without it, which is counterintuitive because fundraising also takes a lot of your time. Similarly, the next best thing is when people are ready to throw money at you at a very good price. There will be times in your company, whether it's because of the kind of where the industry is going, like 6 months ago and arguably still now, or when your company is having a lot of traction or has a lot of attention, that folks will come to you and be willing to give you money for your equity at a price that makes a lot of sense. And in general, when you are a venture scaled business, you are the risky nature of it means that although you might be having some really, really good days, you may be, some really hard days are just around the corner, and that could be for no reason other than the markets have shifted, or you've run into a couple of issues, and doesn't mean that your company's not on the right path in the long run. And so when you have the chance, if the price is right, to build up your war chest, it's always a good idea to save up for a rainy day. Worst case scenario, it means you can kind of go out and when things get bad and bring on a lot of great talent while other companies are struggling to make ends meet. The absolute worst time, and it is generally kind of the only time where you generally want to fundraise, is when you really need the money, because again of those dynamics of power. But through this, I'll try to talk about how we try to, when we have been in these positions, try to shift those dynamics of power to make it a little more even for you. So how should you fundraise? So really, we've put this kind of method together that we use time and time again for our fundraisers. It doesn't always work out this way. There's times where people are just throwing money at us, or times where it's a lot more challenging, but generally speaking, this is the right way to think about it. The first thing to note is that it is a big distraction, and is going to be somewhat of a company-wide effort, because you're going to be needing to get the time from other folks of your team. You're going to need to be finding materials, and so and as a CEO, founder, or a member of the founding team, you're not going to be fully focused on your business, and so a lot of your team members are going to have to be more dependent on themselves. And so it is something that is a big time suck. It's something that the way we think about it will take somewhere between 3 to 6 months to do, from starting the process to getting money in the bank. That's generally the amount of time that you want to give yourself to fundraise. And so really the first part is building a story. And building the story, I think the most important part is the vision, is really what is it that you're trying to accomplish. And generally speaking, by the time that you're fundraising, you should have a good sense of your vision, because at the end of the day, that is what's getting other people to want to join your company in general. And so really for us, it's, when we think about it, the key components of a story is the vision, where we're going and why that's a huge opportunity, what big problem we're trying to solve, and what's the market, and how big of an opportunity that is. And then the second part is current traction. What things have you de-risked from your assumptions of why this business is existing, and or what early signs or larger signs of you being right are you seeing, whether that's customers customers showing interest, users interacting with an MVP of your product, whatever it is that is kind of going to show an investor from kind of, hey, this is what I believe in, to look, these signs are showing that we are right. And then the last part is trajectory. Where do you think you're going to be able to go in the next 6 months, 12 months, 24 months, and how will this capital help you to get there? One of the big mistakes I often see folks do is they focus their slides with why they're raising money on how they're going to spend the money. In reality, when I put my investor hat on, I actually don't care how you're going to spend your money. I care about what results I'm going to get. If you spend all your money on the most random thing, but it's going to get us to where we need to go, I'm totally cool with that. And so in general, I think it's much more important to kind of show a plan to get from A to Z and what Z looks like, rather than to say, I'm going to spend 20% on marketing and 50% on the team, et cetera. The next part is to create demand. And by demand, I mean demand for your equity. And so as I mentioned before, like most things in life, but specifically in the case of fundraising, it's really about power dynamics. And so what you want to do is to start to create demand for the thing that you have a limited supply of, which is equity, room in your round. And so typically what we try to do is ahead of officially fundraising, we create a short list of the great investors that we think are going to be great fits for our company, that are most likely to lead around. And then we start to reach out to them, generally through warm introductions, and have very casual conversations with them. And in these initial conversations, it's not about telling them, hey, you're fundraising today. It's really about letting them know who you are, most importantly, because especially in the early stages, you and your team, that's what they're going to bet on, to what it is that you're creating, and through spending a lot of time to actually getting to know them as an investor. And getting them to kind of speak about them and why they're a right fit for you, I find really important, because all of a sudden it switches the power dynamics table, and they find themselves pitching themselves to you. And generally when that happens, they start to look for reasons of why they're doing this and why they love your company. And so it's a great way to kind of shift the conversation a bit. The other thing to note is the venture capital community is quite small. So as you start meeting with a lot of people, those people will start to talk to each other. And so that's another way where it creates demand. It's also important. The other part of why doing it early on is because these folks don't know you. And investment is a lot of, especially early stage investment, it's based about trust. And so the earlier on they get to know you, the more they're going to get to see and follow your trajectory. And so by the time you come and ask them for money, they'll have a better sense of who you are, what your company is about, and how it's progressing. And that'll make it a lot easier for them to say, hey, I'm going to write a check and make an investment and get behind this company. Once you've met with all these folks, the next step really is to do a deep dive. And specifically what we try to do is we'll email, of the folks that we've met, if there are folks that we find that we really like, we'll reach out to them and say, hey, we're going to be fundraising now. And this is how much we're going to be looking to raise. And we'd like to make a decision with who we're going to go with in the next 4 to 6 weeks. And so the idea is to reach out to a lot of those folks simultaneously, so that they're all on the same track. And the reason for that is, again, in terms of power dynamics, that creates a lot of demand at the same time for the same thing. And so having folks looking at your deal at your pace simultaneously usually will lead to better outcomes. And so what you'll want to do is have, over the course of those 4 to 6 weeks, line up a lot of meetings, initial meetings within the first 2 weeks with all your target investors. If those go well, they'll request a second or third meeting, at which point they'll have an investment committee and then come to a decision. And so specifically, you'd want to say by the end of the 5th week or the 6th week, you'll be comparing offers, and that creates a time crunch for them to come to a decision. At the end of the day, for a VC, it's always better for them to wait to invest, because they get to see more information. And so you want to try to create a urgency for them to make a decision. Otherwise, these things can drag on for a really, really long time. Once you've received offers, once you've received a offer, you will want to go and tell all the other folks that you've been talking to that you've received an offer, and so that they can kind of put another offer in front of you, so that you are in a position to really negotiate the terms of what's going to happen. And then once you've negotiated the terms and really kind of hopefully have had the ability to talk to a couple of people with terms so that you can get to the best terms, then it's kind of the perfunctory legal process where you go through all the details of the long form, you set a close date, and you get all the capital you need. So in our world of blockchain, there are a couple different ways to raise money, and so the 4 common ones are a safe and a safety when it's in the case of tokens, a convertible note, equity, and then tokens. Generally speaking, when you're at the very early stages of a company, you'll want to tend towards a convertible note or a safe. And the reason for that is those instruments allow investors to invest in your company without needing to set a hard valuation. In the early stages of a company, it's very hard to determine what the value of this company is. And so it leads to more efficient fundraising and, generally speaking, to a little safer outcome for the investor, which in the early stages tends to be necessary. And so what you would generally do in both of these instruments, what happens is you set they'll invest a certain amount, and then they will what you will set is a cap to the valuation, meaning that the value that the money they're investing at the time you raise a future round will know their equity, well, their dollars will convert at a valuation no higher than X. And then beyond that X, there will typically be a discount to the next round of financing to reward them for coming in early. So an example of that would be you could raise $1 million at a $10 million cap with a 20% discount, meaning that if you were to raise your next equity round at $5 million, then that 10% discount would mean that they would come in and get their equity at a $4.5 million valuation. However, if you were to raise your next round at $20 million, they would convert at that cap, and so they would get equity at that $10 million valuation. In terms of preference, I prefer safes to convertible notes, both because they're easier to draft, so cheaper, but also because a safe doesn't mean it's debt on your company. A convertible note is debt on your company. And so until it converts into equity, if for some reason you were to liquidate your company or you were to sell your company at a low price, those investors would get paid back first. And so in general, I'm kind of just as a philosophical person, I'm very debt averse, and so I prefer safes to convertible notes. But in the grand scheme of things, it doesn't make a huge difference. When you get to larger fundraisers where the value of the equity is more kind of easily to determine, generally speaking, you're going to raise equity. And so equity is a share of your company. Specifically, when you raise venture capital financing, they'll ask for preferred shares of your company. And so in a company, there can be different classes of stock of shares. Preferred shares means that they get certain rights that others don't. And so it's really important when you talk about that you negotiate those rights, what those rights are. Certain folks, Mark Zuckerberg specifically, was really, really smart around that, where he created 3 classes of shares, where his class of shares had more voting power than any other class. And that's one of the ways he was able to retain a lot of control. Now, that was a rare situation where he was a company that was growing very, very quickly and was able to kind of command that sort of power. But those are the types of things you'll want to think about. One is kind of how voting works. Another one will be liquidation preference. And so preferred shares sometimes can get liquidation preference, meaning that in the case of a sale, they get like the convertible note, they'll get their money out first. Typically, the liquidation preference is 1x, so meaning they'll get 100% of their money out first. Sometimes we've seen VCs try to put in 2-3x liquidation preferences, which are really not founder friendly, because there's no reason, if a company didn't work out, that an investor should get a 200% return on their investment, because they're really meant to be your partner. So those are certain things to look out for. And then in the case that your company is issuing a token, you can always sell those tokens. There's multiple ways of selling those tokens. I rather than going through all those ways, I would just recommend you talk to your lawyer about them, because that can get quite complicated, and it really depends on the jurisdiction that you're in. I'm just gonna take a glass of water for a second. So the next question is really who to fundraise from. And the way I think about it is twofold. Partners who can help you see around the corner. So folks that you think are going to be really able to guide you as an entrepreneur and your company to be able to be a better company in the future. And the second one is partners who can help accelerate your business very quickly. And I think it's really important always to be very discerning about who you let into your company, especially today in the environment we're in. Money is very, very cheap and it's free flowing. And so really when you think about letting people into your capital, into your cap table and owning a piece of your company, it is really about finding people that you're excited about, that will add value to your company, and in general, folks that you'll want to be having meetings with and wanting to kind of bounce ideas off of, because that's really the value that you're getting by having them own a piece of your company. They have aligned interest with you and will be in a way to kind of help you move your company forward. And so for us, really, we look at it as we always like to have a mix of traditional VCs, because as we bring our company, we understand that kind of the crypto world and the traditional world are not completely separate. And in having those folks, we believe brings a little more kind of stability and a bit more maturity in terms of the way we in terms of kind of the feedback we get as we're trying to grow our company. But we also like to bring on board crypto VCs because they have that different perspective, because they have that access to communities and can help us better understand how to interact with different communities and get them on board. The other group that we always love to bring in is folks that can be advisors to us. So individuals that we respect a lot, that we think can both help us in terms of understanding the things that we're doing in a better way, but also can be very, very vocal folks in the community and create thought leadership pieces so that more people are paying attention to our company. Finally, the last group that we like to bring on board, although I would generally say these should be smaller investors on your cap table, are strategic investors. So companies, other companies, big or small, that by having equity alignment with you, you'll be able to create business deals that will accelerate your business. So in our case, some folks that we've done that with are folks like Samsung, Google Ventures, Warner Music Group, Endeavor. There are all different reasons why we brought them on board, but typically we all saw that by having that sort of alignment together, by getting to know each other in more kind of in a deeper way, we would be able to accelerate our business. So I also put on some tips and tricks here. I already hit the first one, but I think this is really important to kind of reiterate. In life, time is our scarcest resource. In a company, equity is, and so it's literally the most valuable thing you can be giving away. And so, really be very discerning with how you choose to give it away. Especially right now, money is fungible, money is abundant, and so really make sure that you're trying to bring on the right people in the right conditions as much as you can. One of the things that I learned really the hard way is you tend to get really excited once you get like some of these VCs that you really look up to, or folks that you look up to that want to meet with you, and you may want to get to meet with them first because they're your top pick. In general, what we found, it's better to keep them last. By kind of having you essentially practice your pitch with people that you won't care too much if they don't end up investing, will be a really kind of great way to learn and iron out the kinks in the way you present your company. And so we have found to try to kind of build yourself up over time from the friendliest people to kind of the potentially the least friendly, but kind of the most important people. The third one is always try to get warm introductions to VCs, especially in the early stages. All of this is based on trust, and getting introduced by someone they know already creates, well, one will kind of ensure that you will get the meeting, but two will create through association the same way as if you introduce me to your friend, I'm going to naturally trust them more. Will create a lot more trust. And so you'll be in a better kind of place as you present your company. We talked about the next one, and I'll just reiterate it because it's important. Really take the time to let VCs to get to know you over time, especially the ones that you care about. Again, it's all about creating trust. It's all about what they like to see is how an entrepreneur grows along their journey. And so the more they get to see you grow, the more you update them in a light way through kind of emails and whatnot, the better it will be at the time that you start fundraising, because they'll know who you are and where you're going. And the last one is traction eats vision for breakfast. And so you can have the biggest vision, but at the end of the day, any sort of traction, any sort of de-risking will have a huge impact in terms of your ability to fundraise with great investors. So I've just done a lot of talking. I'm going to open up to questions and answers.
That was good. Thank you so much, man. That was super, super informative. And because I want to make sure that we get to as many questions as we can, I'm going to jump right into them. One of the community submitted questions was, how do you know how much to raise? Like, how do you figure out what amount of money you want to raise at what time?
So the rule of thumb, I would say, is try to raise enough capital to be able to last a couple of years. And so we like anywhere between 18 and 24 months, again, because it will take you 6 months to fundraise, and you don't want to be fundraising right before you run out of cash. And you also want to be able to have enough time to be heads down working to get to the next place, because it will be a distraction.
And actually, to follow up there, how often do you find yourself, or what do you think of going back to the same people that you already fundraised from versus trying to find new blood?
So it's a good, we try to do both. I think that the issue of going always back to the same people is that you're not going to get, it's harder to find the right valuation. And it also doesn't necessarily signal to the market that there's progress here. And so I think that you may want to accept capital from your existing investors because you have really good relationship, et cetera. But in general, I think you owe it to yourself to go out to the market and really have a sense of what your company is worth. And then figure out who are the best people to bring on board. I generally would say that letting people double down is great, but also bringing new people to the table that can share different perspectives, that have different sorts of connections that can help your business is important as well.
Okay, killer. And then what kind of business plan do venture capitalists expect you to have? You're going to a meeting with a venture capitalist. From their perspective, what are they expecting?
So I think having a fully detailed 2-3 year business plan with business projections, et cetera, it is not really useful. The reality is, especially in early stage, but even at the stage of where Dapper Labs is, it's on emerging technology, it's really, really hard to predict the future. Sure. And so you want to know that for yourself, you want to be able to be prepared for different scenarios and be able to talk to them, but there isn't a need to have a very detailed business plan. I think that at a high level, you kind of want to know what's your thesis, what are the riskiest areas of your thesis, how are you plan to de-risk them, what's your go-to-market strategy, how are you going to start to gain adoption, and really and get an understanding of the dynamics of your business, the economics of them, how those will scale over time.
So it seems like it's not the business plan isn't the important part as much as it is knowing your business is the important part, right?
Yeah, exactly.
Cool. And then, do you need real customers in order to get funding? Is MVP enough?
So it's always it's really the way we think about it is the more you've de-risked, the better the valuation you're going to get. And so if you have a full product that has traction, you're going to be able to raise at a higher valuation, which means that you'll be able to raise more, but more importantly, like be able to dilute yourself less. That being said, it depends. Like, do you need the capital today to get to that next step? Then you should probably go fundraise. But I think that every step, what's important is to raise the appropriate amount of capital to kind of give yourself time to get to that next step.
Okay. Does the partnership structure you choose for brands affect your funding?
So that it affects the business dynamics. And so the types of partnerships you strike with an IP holder in this case really kind of determines what type of company you're going to be. So if you're a business that is going to be licensing IP, you're going to be more of an entertainment company, and so that has very different dynamics than if for example you're in a place where brands are utilizing your technology and you're more of a platform play. And so I think it's kind of the opposite way around, whereby I think you first decide what type of company you want to be and what it is that you're trying to deliver and to whom, and then based on that you try to strike the right partnerships, the appropriate partnerships with your customers or with your licensees or licensors, whatever the case may be.
Cool.
And if you're struggling to find that probably means that your thesis is wrong and that you're in a different business than you think you are.
Right. Okay. And then I think my favorite of the pre-submitted questions, which is really trying to get after what we want, is what type of projects does Dapper fund? What type of projects do we fund?
So we get excited about folks that are building new technologies, hopefully on Flow, that can push the industry forward. Like our mission is really, how do we bring billions of consumers to the blockchain, and that's where we try to focus on it. And so that doesn't necessarily need to mean, hey, we're a pure consumer play that's going to just kind of bring on new people, but it could also be interesting new applications that can deliver a lot of value to folks that have come into the blockchain space as well. We tend to look for folks that we have high conviction are great founders and can be great leaders. And when I think about that, I really think about their ability to learn quickly. And that's kind of hard to tell, but it's something that we look for.
I think that might link back to what you were saying before about, making sure that the VCs kind of see you grow. And I think that's something that you probably learn over time, as opposed to learn in one meeting, in one pitch or whatever. Okay, let's get to some community questions that were asked during your presentation. So Nate McGuire asks, at the early stage, it can be tough to create demand without much traction. If you have a strong vision and MVP, it seems like it comes down to investor fit. So with that, do you have some favorite investors in the space that are enthusiastic about super early stage projects? And since the space is relatively new, it's unclear who is investing early. Do you know of anybody?
Yeah. So after this, I'll share my email and just please email me this, and we kind of like and we keep lists of folks that are appropriate for different stages. But I think in terms of fit, it's not just stage, it's also what it is that you're building. So there are certain investors who really focus on consumer plays or NFTs, others that are focused on DeFi and architecture, and so there's different people who have different kind of areas of focus, and it's really about getting to those. What I did, kind of the way we built our list, etc., was really about taking a look at who's investing in what, and then and using that for a signal. So a really good resource for that is Crunchbase, or just Googling a company that is in your industry, somewhat similar, slightly different, and seeing who's been investors in their round, especially at your stage, angel investors, and that'll give you a really, really good sense of who to target.
Cool. And the follow-up there is, it fits literally right here, which is, if you have two investors that are looking to make the same offer, how do you pick which one to go with? How do you kind of grade your investors? What rubric are you using?
That's a hard one because it changes for every person. It's quite personal, but I would say it's and it depends if they're leading or not. If they're leading and you think that they're gonna end up being a loud voice in your company, I think first and foremost is, how do you feel spending time with them? Do you think that they're giving you good advice? Will they be a good sounding board for you today and 5 years from now? And so that's kind of the first rubric. The other two, I would think of like their ability to accelerate your business in a way, shape, or form. And I guess fortunately, unfortunately, I would say the clout that they have, because that's important too. Investors coming into your business send signal, and that makes a lot of things much easier for you, whether it's getting new partners or getting in future investors in your round.
Thanks, George, for that question. And also another kind of follow-up to that from Kelly is, what are red flags for VCs? What are some good tips for vetting VCs to begin with?
So one of the things that I would say is before you raise, and we do this all the time, before you raise money from an investor that will be important on your cap table, go and reach out to other folks they've invested in and see what their experience was like. That is the best predictor of whether or not.
You almost want a glass door for VCs so that you can just look at their Yelp reviews or whatever.
Yeah, but you'll be surprised. Most investors, most entrepreneurs will be happy to talk to you about those VCs, and it could be really illuminating. And one of the things we look for is, pretty much every company goes through really, really hard times, and so we tend to ask. And what you want out of a partner is, it's all great when things are going really, really well, but what you want to kind of see is like, how is your partner gonna react when things get really hard? And so when we do reference checks, that's where we focus a lot of our time on, is kind of have they been good partners, and how have they reacted when times got tough?
I agree. I mean, yeah, the times being tough shows who you are, right? So that's probably the thing that you want to ask first. When you're raising, this is from Craig, when you're raising money from angels versus VCs, how does any of the information that you've kind of gone through today change? Are there any major differences between angel investing and VC investing?
I think with angel investing, typically you're not going to have a lead investor, and that's not always the case, but often is the case. And so it's really more about trying to wrangle a group of people to invest in. And so in that case, I would still say that the the folks you bring on are quite important in the sense that they're going to be showing a lot of signal, and they're the people you're going to be interacting with a lot. But they're, in the long run, they're not going to have as much of an influence on you as a company. And so you don't need to be as kind of scared about like, well, one day they shouldn't be getting a board seat or anything like that. And so you can be a little less discerning in that case.
Cool. And then this question from Chris is, given the explosion of NFTs this year, do you feel there is more ability for flow partners to self-fund, or is it more that investor funds are easier to get right now?
So it's an interesting one. And I say that because like so if you go back to kind of the history of like Dapper Labs is a spin out of Axiom Zen, and our whole philosophy was that raising early kind of like messes up the incentive structure for entrepreneurs, in the sense that we think that when you raise really early, you've got a bunch of people bought into a specific vision, and that vision is likely wrong. And so you want to be in a position to iterate really, really quickly and find the right vision and find the right product. And you've got folks that were sold on a specific vision, and that can create a bit of dichotomy. And so our view is try to self-fund and iterate as quickly as possible. And once you found some sort of product market fit, then raise. But that's kind of contrarian. And so most people don't go down that road. Today, I would say it is a really good time to fundraise. And so the need for kind of bootstrapping yourself is a little less, but those are all personal choices. And I think everybody needs to go down their own path on these things.
There's actually a couple things that have been maybe the opposite of what I think people would have expected. And one of them was, when you're making your slides, it seems reasonable to explain what I'm going to do with all of this money that this VC is going to give me. And your feedback was kind of, I don't really care. I want to know what the end point is. So what other big mistakes that you think, or do you think people are making that they might not think? They might think this is what they want, but it ends up being kind of counterintuitive and ends up hurting them.
I'm gonna have to think about that one for a second. I tried to highlight the biggest one,
which is like, if you want to go with like, these are things that people do, and this is what you should do as well. Like someone did this and they killed it, and that's something that you should do as well. So either one.
So I think actually the one that came to mind as you were speaking, and it's something that I found people do also when they job search. The tendency is to kind of find a target that you fall in love with and just go after that. And then if that doesn't work out, go after the next one and the next one. And doing these things sequentially is really kind of bad, because you're going to lose a huge amount of time. And so really kind of trying to create a process that parallelizes everything at the same time, is really important.
Yeah, tunnel vision is probably not a great idea when you're trying to raise a bunch of money. Get focused on one person. You mentioned putting into the slides evidence that you're right. What are the best signs of being right? What are the things that you think are like, oh, this is a sign of being right that you can use?
Yeah, so I think it goes back to the first thing is it kind of like the process we look at is so what is our we have a vision. What is our thesis? So in the case of CryptoKitties, it was that we believe that fun and games would be an easier way for people to engage with blockchain for the first time. And so the kind of then it's okay. Well, how do I de-risk that? What are the things that will what are the quickest and easiest experiments that I can run that will show me whether I'm right or wrong about that thesis? And so for us, one was like, well, are people adopting blockchain that never owned a cryptocurrency before? Yes or no? Are those people behaving in a way that shows that they understand that this thing is more valuable than other kind of game assets that they've had in the past? Yes or no? and how does that look like? So it's kind of, so there's no kind of like right or wrong answer, but it's just kind of taking that approach to your business and being able to talk about it and show that you have proof points that you are on the right path and that these things are correct.
Sure. And negotiating is hard for most people, right? This is not an easy skill set that people develop as they're growing up. And so asking for money is hard. Negotiating equity is hard. What are tips or tricks, or is there some book that you read or some workshop that you did that helped you like relax when it comes to asking for money and negotiating what you want?
So it's funny that I ended up with the job that I have. Like I used to be an incredible, and still am in reality, an incredibly shy person and someone who really deeply hates to negotiate. And I remember the first time I just walked someone, in this case, it was a customer, through my product. And at the time, it was in my first company where I had my co-founder was the business person, and he ended up leaving. And so all of a sudden I went from product to being the business person. I was shaking. I was in a computer thing, and I was shaking and I was sweating. And so I think the two things that helped me well, one is just repetition. Mm-hmm. Just like, if you do things enough times, at one point you'll be like, okay, well, I know how this feels. I feel comfortable in feeling uncomfortable, and therefore it's all good.
And that you kind of mentioned with like practicing with a warm audience, practicing with VCs you don't care about that much, making sure you get the reps in.
You get the reps in, get like fail early in lower pressure situations. Right. All those things help. The other thing that helped me a lot is, and because we have a tendency to not want to ask things for ourselves. But the thing that helped me a lot was kind of stop thinking about it that way, and to start to think about it, well, this is not actually about me. This is about my team members and all the other people that are part of this journey that I'm on. And so what I'm trying to do is not represent my interests, but I'm representing their interests. And it's a lot easier to fight for others, I find, than to fight for yourself and to have like a lot, kind of feel comfortable having strong conviction. And so that's the one tool that has helped me the most, is really kind of having that mindset that I'm doing this for a lot of other people and not just for myself.
Very cool. Well, I think that's about all we have time for today. I want to thank you for an awesome presentation, for giving those words of wisdom. I learned a ton. I'm sure our community did too. I want to thank everyone for being here today. I'm sorry we didn't get to every single one of your questions. I know that there were some questions that were left out there. So if you have more questions, please feel free to submit them in the Discord. Obviously, you can find Mick on Twitter as well. Any last words from you as well?
No, thanks so much for all being here. This was a lot of fun for me to get to share this wisdom that I've accumulated over time. And yeah, if you want, feel free to reach out to me on Twitter. I'm at Mick_Naayem. Yeah, thank you all for being part of the Flow community.
Thank you all for being here. Please make sure you subscribe to our YouTube, follow us on Twitter. We'll be having more of these AMAs to come, and we look forward to seeing you then. Bye, everybody. Take care of yourselves.
Thanks. Brilliant.
Thanks, everyone. This was brilliant. Thanks, Mick. Thanks, Shelby.